The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I've got to start the show with a dad joke because we're talking about inflation and what's related to inflation is interest rates. And I think this is going to be an interesting show, Henk. I'd just like to welcome my guest, Henk Kotze. He's head of cash and income at Prescient Investment Management. And we're talking all things global inflation and interest rates. And actually, what does that mean for you and I as investors? So welcome back, Henk. It's nice to have you back on the show.
Good morning, Warren. Thank you, everyone. And yeah, it's always great to have the opportunity to share a platform and talk about things that we really enjoy to talk about.
So, we always want to make this relevant to an investor. So I just want to sketch a little bit of the background to what we're talking about. And we're in an environment where we've had a few years of very high inflation, especially in the US and Europe. And even South Africa has been affected by that. And the kind of only real medicine that the reserve banks have around the world to deal with this illness of inflation is interest rates. And interest rates have been high. And now we're in an environment where it looks like, and I always think, we call the end of inflation too early when we're investors because we're desperate for it to kind of get past. But I'll be brave enough to say it looks like we're on the other side of this inflation story. How long it takes and how much it's going to come down, I think we don't all know. But what we do know is that that's the starting point. So Henk, when that happens, when inflation starts to come down, kind of what are the next steps? What do we start to think about now as investors?
Yeah, so Warren, I think globally wanting to understand what's going on in the US, right? So from our perspective, there's sort of two things we need to first consider. The first one you've touched on is inflation, but I will talk about that second because I do think that's most important. But the other side of the coin, when it comes to interest rates, really is around the growth story, right? And what we have found and what we will find going forward, there's a lot of talk around the US, the growth. Are they going to recession? Where are they in terms of growth, et cetera, right? So at Prescient, again, we're very systematic in the way we do things. So we look at the numbers, we look at the data, the evidence. And if we look at what we call our nowcast or our Prescient economic indicator for the US, we're seeing them growing around 0.9% currently, right? So what we do with that is where they're growing right at this moment. So if you think back to about last week, there was a GDP print. That was for June. We're now in September. We're in spring, thank goodness. It was a long winter in Cape Town. So that information doesn't really help us, right, from an investment perspective. But 0.9% growth in the US is still a good story, right? So we're not seeing a recession on the horizon. Yes, growth is slowing. Yes, we are seeing the impacts of the high interest rates, but we're not going into recession. That is important because if you had the other side of the coin where we saw recession and quite a drastic downturn in economic growth, you'll see the Federal Reserve in the US react quite aggressively, and that's usually followed by what we call risk off, right? And for us as South African investors, that's not such a good thing. Okay, so yes, on the growth story, that's a good thing. There's still some growth, not really a lot, but certainly not a recession. Then on the inflation story, 100% Warren, we've seen the back of it. So if you told me 10, 15 years ago that we would see 9.1% inflation in the US, I would have told you you're crazy. That is what we saw sort of post the disruptions from COVID, et cetera, and all the talks around, was this 9.1% the new normal or was it a transitory thing? And were we going to go back to the normal sort of 2.5% interest or inflation rates that the US sort of gotten used to throughout a number of years, right? And what we are seeing, if we again look at the data, is that inflation is normalizing quite quickly. So the key driver there at the moment is really house prices in the US or shelter. That's the component that looks towards rent. That's coming down quite quickly. And we are seeing US inflation going back towards that 2% in the not too distant future. So by the end of the year, you should see the inflation sort of story back to something a lot more normal. So what does that mean then for us as global investors when it comes to interest rates? The interest rates in the US, really the risk-free rate, around 5.5% or 5.4 currently. That is exceptionally high. So there's an absolute fantastic opportunity in that. But what we are seeing is that rates will start coming down, not too long from now. And the first expectation for rate reduction in the US is priced for this month. So 18th September, if I'm not mistaken, is the Wednesday. We see the Federal Reserve meeting. and the market is saying there's a strong probability that they will reduce rates by 0.25%, so 25 basis points in our world. And that should kick off a series of great events for global markets. A lot of risk on, a lot of opportunity, and certainly still opportunity in the fixed income space as well globally.
So let's say we've been in an environment globally, at least, where we've had quite a lot of headwinds just because of this inflation and then the interest rate story. And now we're in an environment where at least it feels like the headwinds have slowed down a bit, and maybe from September through to the rest of this 2024 and maybe into 2025, we get some tailwinds of falling interest rates. And I think it's maybe just worth touching on how difficult it is for a central bank to control inflation, because it's very sticky. You feel like you've beaten it, but then the following month you'll find some number suddenly shooting up again. And I think people don't really appreciate that economies don't work exactly at the same time. So all the sectors of the economy don't all rise at the same point and then all fall at the same point. They do it in kind of a mess, a general pattern. And so for a reserve bank to kill very high levels of inflation without putting the economy in recession is actually almost miraculous. I always think back to that airline pilot who managed to land the jet plane on the Hudson River, and that's what they will have done if they can get the American economy through this without recession and normalize inflation and normalize interest rates. They will have landed a massive jumbo on a very small river.
100%. When you think about the central bank's job, is they have to make a decision with the info they have right at hand, right? And things change so quickly. So for them to be able to do something like you said, land this juggernaut of a plane in an environment where globally we saw an enormous existential shock to the global system in the form of COVID, supply chains getting decimated, was actually, it is miraculous. And that's what we're seeing. They are able to get inflation back down to that 2% handle. They haven't started cutting rates yet, and the U.S. economy or the global economy hasn't fallen off a cliff just yet. So certainly a win for all of us. And we should all start experiencing and expecting some relief on the rate side as global investors as people on the ground.
So Henk, I'm sitting here thinking we're in an environment where we're going to have some economic tailwinds of lower interest rates. Having said that, we're also in an environment where at least the US stock market, maybe a portion of the US stock market, has just been delivering fantastic growth, month after month, year after year. And not putting words in your mouth, it's my view that those big tech shares are ridiculously expensive. And so kind of, I'm sitting and thinking to myself, when you're in an environment where a general market has gone up for quite some time, and not in a straight line, but it's been fairly consistently going up, that does pose some risks. So I'm sitting and thinking in my head, we've got very good news, which is falling interest rates. That always gives an impetus to the property market, the bond market, and the equity market. But then we've got a situation where a portion of the world's biggest stock market is very expensive. Now, if I'm an investor, I'm looking at this whole world. I don't have answers to those kinds of questions. So how do you look at that and then say, okay, no, this is what we do going forward?
100%. So for us at Prescient, we think about things a little bit more systematically. So for us, we see 4 drivers of asset classes. So if we want to take a view on something like US equities, as an example, we want to look at valuations. We touched on that. Stock markets have rallied quite hard. They are looking very expensive. Then you need to think about the economic situation. There again, we're looking at sort of things like the Prescient economic indicator, surprises on the economic data, etc. You need to think about monetary policy or financial conditions, as we would call it. That's really the interest rates, the strength of the dollar, etc. There it's all still very tight, right? So you think about the inverted nature of the US yield curve, the ability for businesses to do business with the interest rates where they are. So that's still very tight. And then finally, if you think about sentiment, and those factors are actually still quite negative. So you have a strong case against valuations. Economics hasn't really turned. Financial conditions will start turning, but not yet. And sentiment's pretty low. So we agree that certainly US equity is not really the place to be. We're strongly underweight there. But what happens when the Federal Reserve starts cutting interest rates is that the global risk-free rate, or the benchmark for assets to beat, which is really the US interest rate, starts coming down. And investors who sit with money in the bank, who were earning 5.5, now all of a sudden start earning less and less and less. And they need to start finding houses for their capital. And then things like emerging market equities or South African bonds, etc., start screaming really, really attractive. And you'll find money flow across the globe as this rate in the US goes lower, and investors need to find houses for capital. So we see a lot of lazy capital because of the rates being high, but that's going to change quite quickly. And we do think that South Africa, but globally, emerging markets, etc., will be the beneficiaries of that capital flow. And then things like global interest rates. So they are still quite elevated. There is still some opportunity, US bond market, etc., etc. So US equities probably not so much, but the rest of the sort of complex does look really attractive.
So it's a nice phrase, that lazy capital. So just to explain that, so that's people, and I guess mainly big fund allocators that are not sure what to do, and they're worried about the state of the world. So they go and park their money in short-term cash, in the US, earning high interest rates where they don't have to think. That's why it's lazy, because they can just earn the interest rates and do nothing.
Yeah, if you think about inflation currently, let's call it 3%, and that's being sort of overly pessimistic. And you're earning 5.5 in your bank account. So you're getting an inflation plus 2.5% return with absolutely no risk.
Okay. So now, Henk, let's maybe bring this to South Africa. So we're looking at an opportunity set around the world. There are opportunities for investors to make money around there. And to your last few comments, it sounds fairly positive also for South Africa that we could see a flow of money back into emerging markets, and SA being one of them. What are the opportunity sets for us here?
Yeah, so I think there's a couple of things one needs to think about. So as an investor, if you make the decision to go offshore, there's two things there. One, you make a decision on the currency, right? And two, you need to think about the asset class that you decide to eventually invest into. And what we have found for a lot of South Africans, when they make that decision to go offshore, it's a pure decision to not have rands, but to have some other currency, usually the dollar, right? And then the second question then comes up later, which is actually quite interesting, is they don't really know what to then do with the money, right? Now you sit in a bank account. Luckily, it's been a good ride in your bank account, but that's going to change. And for investors, for South African investors who have money offshore, they need to really start thinking carefully about where do they invest that money. And what we are seeing, and we're finding quite a lot of appetite in this, is a lot of opportunities in what we would call the global income space. So those would be sort of opportunities in the credit markets globally where it's still fixed income but floating in nature. So that means you're not taking interest rate risk because you're floating with the market, but you're earning a spread or a compensation on top of your interest rate for taking on a diversified global basket of credits for different banks, all very, very highly sort of rated, so a lot higher rated than South Africa as an example. And you're earning 1, 2, 3% on top of your interest rate. So there's a lot of opportunity for you then to find those houses for your capital rather than sitting in the bank account. And I think for South Africans, or at least we think for South Africans, that's going to be a very key decision that's going to be made going forward. As you've now made your decision to go offshore, now what do you do with your capital? And there's a lot of opportunity if you are a little bit more sophisticated, think about it a little bit more deeply and find some of those ETFs, exchange traded funds, that give you a diversified, cheap, global fixed income exposure as a South African investor.
And I guess there, in the past, we would have been very limited in terms of what we could actually do from a local base to go global. But it seems to me that your opportunity set for accessing global investments in South Africa is expanding all the time.
Absolutely. So, I mean, we run a global income fund. I mean, that's no new news. But in that fund, for us as an example, we've changed our process to now incorporate all these global opportunities on asset classes. So think about global high yield or emerging market corporate debt, emerging market government bonds, all these sort of things. You can now access via exchange traded funds because the proliferation of them coming to market, the growth in their size, etc., how cheap it is for us to actually access that has given us as South African investors the ability to now compete globally by buying these different asset classes, creating a process around that, and then giving South African investors the opportunity to buy a portfolio of these assets managed by us, obviously, or different asset managers, and get this global diversified income exposure at a very, very low cost, but also a very low risk level. And that's the wonderful thing about the financial markets. As things evolve and new products come to market and new sort of ways of innovation, it creates the opportunity for people, investors, South Africans or global, to really have the opportunity to invest into these asset classes that previously was really just available to professional or call it institutional investors.
Yeah, and I must say, for me, that's very exciting. If I think back to when I started in this, in the late 1990s, the opportunity set for South Africans to access global investments was almost nothing. And what we could buy was phenomenally expensive and very badly run. And so I think that, now getting to the point where, accessing global ETFs inside portfolios becomes, really attractive and gives us the ability to compete with anybody anywhere, which is really exciting.
We think about markets. You don't really want to be stock picking in the global space. You just don't have the hundreds or 200 of analysts to really give you that edge. But I don't have to have that edge, right? I can have a view on asset classes, buy that ETF that gives me 2,000 names, diversified at not even 10 basis points. So it really has changed the playing field, and it gives us as South Africans the opportunity to compete globally.
And to give that context, 10 years ago, let's say, you would have had to buy a global equity unit trust, and that would have probably cost clients 1.5 or 2% a year. Then you would have had to do an asset allocation on top of that. Now you're buying a global equity index at 0.1%. That's the difference. 1.5 to 0.1. And being able to offer a good solution on the other side for a client becomes much more viable. And I think it's very exciting. Henk, we're almost out of time, and I wanted to give you the opportunity to, if for someone's listening, to say, what should they be thinking about in this environment, and what's kind of the golden nugget that you want to give them to take out of the next few months.
So if you've made the decision to go offshore, a lot of the rhetoric would be now that interest rates are coming down, we expect them to be cut. You need to think about not having income exposure or interest rate exposure. I would hazard a guess to say that that's probably incorrect. There's still a lot of opportunity in the global income space to earn really good real returns. As inflation normalizes, interest rates will stay at a level that will give you that. And as we've said before, there's a lot of asset classes, specifically US equities, that has been sort of the traditional house for money going offshore. That is very expensive, and with the slowing growth environment, credit spreads being arguably very tight, one needs to think about a global diversified solution when it comes to finding real returns in the offshore space, and we're certainly finding that in the income space, from a global diversified ETFs perspective. So we're seeing a lot of opportunity, a lot of appetite for that, and we would certainly tell investors to think about that very carefully when you've gone offshore. Make sure what you're buying gives you that real return at a fair price. That's also very well managed from a risk perspective.
I think it's a fundamental point, that we always think of investment worlds as either or. And to me, over long periods of time, the best investment returns are always through having a combination. So it's not either or, it's and, equities and fixed income, and not just the US and not just emerging markets. You've always got to have proper diversification in a global context. And I think we too often, I know especially me, because that's kind of where I grew up, we tend to focus on equities too much, and that can come at a huge cost to investors, both from a risk point of view, but also from a risk per kind of unit of growth as well, and managing that growth at the right risk is key. And I think diversification is a solid point that we forget about a lot. We think diversification is, South African equities versus global equities, and that's just not true. There's so many more asset classes out there.
100%.
I did say at the start that this would be an interesting show, and it was. We managed to talk about interest rates and actually keep a very nice topic. I appreciate your input. Thank you so much for being back on the show, Henk Kotze, head of cash and income at Prescient Investment Management. It was a pleasure, and I'm sure we'll have you back on the show again.
Awesome. Thanks, Warren. Thanks everyone for listening, and good luck again.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.